Join the club of the richest 1%. By employing the strategies in this video, you can become rich and established and join the club of the richest 1%.
The knowledge and strategies in this video are rooted in Jacob Nayman's extensive experience, distilling more than a quarter of a century in his role as a leading investment and economic advisor to some of the world's wealthiest. Infusing your life with the financial strategies outlined in this video will enable you to achieve the most important goal of the 21st century: financial independence.
The better alternative to buying individual stocks is to buy an index that represents the investment channel in which you want to allocate your money. For example, instead of picking and buying 3 or 4 stocks that belong in the technology sector, we can buy an ETF, exchange-traded fund, that represents the NASDAQ 100 index. This allows you to buy a small piece of the stock of 100 different companies in the NASDAQ sector with a single investment. Why investing through ETFs is better than buying individual stocks? Reduced portfolio risk. When you buy ETFs on indexes, the volatility risk of the investment portfolio is much lower than when you invest in specific companies. Reduced portfolio fees. ETFs offer low expense ratios and fewer broker commissions compared to buying stocks individually. The low fees mean that more of your investment stays with you rather than being drained off by the investment house. Improved focus. Base your stock market investment decisions on which investment indexes/sectors are the best to invest in, not the question of which individual stocks to pick and buy. Time savings. In order to invest in individual stocks and do it well, you must invest a great deal of time doing research and a great deal of attention to monitor the stocks. The main points. Buying ETFs on indexes enable you to easily implement the golden rule: don't put all your eggs in one basket. Buying ETFs on sectors or indexes diversifies your investments and considerably reduces the volatility of your portfolio. Buying ETFs on indexes or sectors reduces your fees.
Is predicting your economic future a riddle wrapped in an enigma? Not quite. It's about creating it. Financial practices shared in the earlier segment, courtesy of financial expert Jacob Nayman, are your toolkit for securing that future. But here's the catch. Knowledge isn't the ultimate prize. It's action that truly counts. The upcoming segment aims to spark that drive, that motivation within you to implement these strategies. So take note and remember, in the grand chessboard of finance, it's not the player who knows the most moves, but the one who actually makes them, who wins. This video contains valuable information. Use it.
Imagine you've put all your hard-earned savings into one company's stock, only to watch it plummet overnight. A chilling thought, isn't it? But such is the reality of individual stock investing. The volatility of individual stocks can be as unpredictable as the weather and, in many cases, just as destructive. Take, for instance, the dot-com bubble burst at the turn of the century. Many investors, lured by the prospect of quick riches, poured their savings into tech companies only to see their investments evaporate as the bubble burst. Or consider the infamous Enron bankruptcy, where thousands of shareholders were left with worthless shares. These examples serve as stark reminders of the risks associated with individual stocks. One wrong move, one piece of bad news, and your investment could be reduced to rubble. Put simply, investing in individual stocks can be a risky gamble, one that not everyone is equipped to handle. Now picture a different scenario. Instead of investing in one single company, you spread your investment over hundreds, even thousands of stocks. This is the magic of exchange-traded funds, or ETFs. They work like a basket, holding a diverse range of stocks, bonds, or commodities. This way, your investment isn't tied to the fate of a single company, but rather the collective performance of multiple entities. Consider the S&P 500 ETF as an example. This ETF represents the 500 largest US companies. So when you invest in this ETF, you're essentially investing in these 500 companies all at once. This provides you with a broad exposure to the market, reducing the risk associated with individual stocks. If one company underperforms, it's balanced by the others that are performing well. By investing in ETFs, you're not just putting your eggs in one basket, you're spreading them across an entire farm. So let's sum up. Why are ETFs a better choice than individual stocks for most investors? Well, for starters, ETFs offer a more diversified investment. This reduces your exposure to the risk associated with a single company's performance. You're spreading your bets across a wide array of companies, sectors, or even countries, which can help smooth out the bumps in the road caused by market volatility. Secondly, ETFs are less likely to be affected by the failure of a single company. If one company in an ETF fails, it's only a small part of your overall investment. This safety net can be a lifesaver in a volatile market. Lastly, ETFs tend to provide a more consistent return over the long term. While individual stocks can offer sky-high returns, they also come with sky-high risks. ETFs, on the other hand, offer a more balanced approach to investing. In the world of investing, ETFs are the safer, smarter choice for those looking to minimize risk while still enjoying the benefits of the stock market.